Hi, my name is Nick Wadenstor. I'm with Baca Systems, and welcome to another episode of our virtual fabrication seminar. In this seminar, we're going to be talking about equipment financing and leasing. And we have today joining us is Josh from AFP, American Financial Partners, who will be joining us here in 1 second. As always, Baca Systems is focused on developing innovative fabrication solutions for the countertop industry and is the leader in the robotics project technology. We have 30 years of implementing robots, over 450 systems installed, and software is easy to use and certainly known for our water jets as well. So today we're going to talk about how you finance these pieces of equipment. It's a common question when our customers are calling us. Understanding, okay, do I go to a bank? Do I go get a lease? Do I pay cash for it? What's the right way to go about purchasing the equipment? And so there's a bunch of different options, based on what's best for you. Leasing is commonly comes up. We have a number of leasing companies in the industry, and we use American Financial Partners for a number of different reasons, but I'm going to go and introduce you guys today to Josh Penman. We've been using Josh basically since we started with Baca Systems. Josh and his team have become a wonderful partner to us and have helped a lot of our customers financing equipment. So Josh, thank you very much for your time. And I'm going to let you introduce yourself and your company, and we appreciate you joining us today.
Thank you very much, Nick. I appreciate the opportunity to be on with you guys, with Baca Systems and all of the current customers and potential customers of Baca Systems. As Nick said, we have worked together. I think it's around 9 years already, and I have been specifically working in the stone industry for about 12 years, and I've been doing equipment financing and leasing specifically in different construction areas for over 20 years. So I've been doing this for quite some time. I did work for 10 years for a large bank, US bank. So I'm familiar with the way banks work, and I'm also familiar with the way banks view a lot of times construction industries and construction companies. So I like to think that I bring a little bit of the best of both worlds in that, I understand banks and their processes and how they work, along with, more independent finance companies and how they're able to do things more flexibly than a bank would be. Andrew, you want to go to
Excellent.
the next slide?
So, yeah, and I'll let you roll through this, Josh, and you can sort of explain. I think what we've got here is the, kind of the differences between a bank loan, a lease, and cash, right?
Yep. Yep. Andrew, do you want to go back one? I think we may have skipped one slide there. Okay. Nope, we didn't. So yeah, Nick is right. These are going to, there's going to be some redundancies here where we talk about certain things or I talk about certain things, but the bottom line is this table is meant to show the difference between a traditional bank loan, a lease or a finance agreement with American Financial Partners, or another finance company for that matter. And then the final column would be just paying cash. So the first item is turnaround time. Bank loans tend to take quite a bit longer than than a leasing company or a finance company. Bank can be days to weeks. If you're going through an SBA process, that might even be longer. I mean, that can be months at that point. We can get things done in as quickly as a day. We're application only up to $500,000. The turnaround time for us is really going to depend primarily on credit, time in business, and the total amount that you're looking for. And then obviously
Yeah,
cash
and
is
so
going to.
you're gonna,
Yeah, go
yeah,
ahead.
yeah, cash, ready to check for cash.
Yep.
No, we hear that a lot, and so, normally what I try to explain, maybe you can, clarify is, you know, you guys understand what the equipment does, right? You understand what it does for a guy's business. And so you guys going out and leasing the equipment makes it easier for you to understand the return on investment. Is that correct?
Absolutely, yeah. And as I mentioned in the previous slide, it because we specialize in the stone industry, and even more broadly, we specialize in construction as a whole. So where banks may not understand what a dual table RoboSawjet does, we understand that very well, and we understand the impact that can have on your business.
Excellent.
So
Okay.
another, the second row there is, this is another big one. Cash is king. So banks, obviously the third column there, cash. If you have the cash and you don't have a need to conserve the cash and save it for other items, other things that the business might need, then this isn't really an issue for you. But a lot of customers, a lot of fabricators we work with, they want to conserve their cash. And banks are typically, we say 10 to 20%. A lot of banks, especially when there's uncertain times, a lot of banks will ask for even more than 20% down on a loan for specialized equipment, which banks will consider this equipment specialized. Where we're typically going to finance 100% on newer businesses and businesses with maybe some credit blips, some credit hiccups personally, then we'll get maybe zero to or up to two payments up front, and then possibly, especially on the newer businesses, which we would consider startups under 2 years, then we typically are looking at around 10% down. The next
Nice.
row of soft costs, we can also include soft costs like the installation, the training. If you want to roll in any electrical work, we can do that. Concrete work, things that you wouldn't think you could finance that you maybe would have to write a check for, we can include that in the financing here.
Oh,
The
that's
required
fantastic.
info bank. Yeah, go ahead, Nick.
No, I was just saying that's fantastic because there is, sometimes there's rigging that needs to be brought in for the machinery, right? So
Yep.
that's good to know. That's a great point.
Yeah. Yeah, and another big one is the next row there is required info. As I mentioned, there's a typo on our section there, but we're application only up to $500,000. So what that means is we're going to credit score everything, look at personal credit, business credit, time in business. Whereas on the bank side, you're typically looking for 2 to 3 years of tax returns, personal financial statement, projections, business plan. There's a lot more extensive file that goes into that, and a lot of banks will bring that to credit committee. And especially smaller banks, it takes a long time, to make that decision, and a lot of times it takes you guys a long time to gather all that information. So makes it a lot quicker and easier to use this type of a product as opposed to a traditional bank loan. From a collateral perspective, a bank is going to file a blanket lien on all your assets, where we're only taking a UCC filing on the equipment we're financing. So it's not going to tie up all of your assets to use a finance company or a lease company.
So
Annual finance.
a bank loan I'm sorry, Josh, a bank loan could affect your maybe your line of credit that you have with a bank.
Yeah.
Like, okay, I've got a line of credit, I'm using it, I'm buying material, I'm doing whatever I'm doing with that, and then I go get a bank loan. Can it affect that line of credit where a lease won't? Is that right?
Yeah. Yeah, and I mean that's basically an exposure issue. Okay, so if you're going back to the bank for a loan, all of the exposure you have with them, whether it's equipment loans, like you just mentioned, lines of credit, or real estate, the bank has exposure with you, and the more exposure you add, it's good to have pay history and things like that, but a lot of times that exposure will affect your ability to borrow more money with any one bank. So I'll tell a lot of customers, our pricing is going to be similar to a bank, but without the down payment. So why not use a finance company who specializes in this type of equipment, this collateral, and this industry, and leave the availability with your bank open for working capital, for lines of credit, for real estate transactions, because those are things that we don't really get involved in, but those are things that banks are very good at, and that's what we all need banks for. Okay. The tax benefits, we'll get into section 179 in a bit more depth here in a few slides. How payments are figured with a bank, it's tied to an interest rate. You're essentially borrowing money. So if they're going to lend 80% against a $300,000 piece of equipment, you've got an interest rate that's based on a $240,000 loan. What we do with equipment financing and leasing is the payment is tied to a rate factor. So we'll take our factor and multiply it times the equipment cost to come up with what the actual monthly payment is. And that's a lot of times based on 100% of the equipment cost. So there's not really a principal and interest breakdown per se. Fixed payments. So for us, interest rate, or for a bank, interest rates can be variable. That's going to be more on more of a line of credit. Typically, a bank equipment loan is going to be a fixed rate. With us, it's always a fixed payment. It's never going to vary. It's never going to fluctuate. Structures, banks tend to be pretty limited in how they can, structure a loan. We, on the other hand, are going to be much more flexible. We can do a 90-day deferral. We can do, seasonal payments don't necessarily apply as much in this industry. And then we can also do skip payments, ramp up type payments where they're smaller in the beginning and then they grow as you start to use the equipment and, and start to take in cash flow from the equipment's use. Early payoff, this does come up quite often with a bank. It is a principal balance. With most leasing companies, it's going to be the remaining stream of the payments. With us, it's a little bit different. We do have we have a buyout of the remaining payments with a discount, so it makes it look a lot more like a simple interest type buyout. And then ownership of the equipment at the end of the term with a bank, yes, once you pay off your loan, you own it. And that's the same with us. We typically have a dollar buyout lease or an equipment finance agreement. So at the end of the term, you do own the equipment. So a lot of people shy away or are scared by the term lease just because they think of a car lease. They're not going to own it at the end. It's more like a rental, where this is quite a bit different than that. You do own the equipment at the end of the term with us.
And I'm sorry, Josh, did you say that could be like a dollar buyout at the end? Is that what you were saying?
Exactly. Yeah. Probably 95% of the quote unquote leases that we write are a capital lease where the customer owns the equipment at the end of the term.
Excellent.
Okay.
Okay.
And as I mentioned, there is going to be some redundancies here. We kind of talked about a number of these things, but again, these are the main differences between what this type of, more of a private equipment finance company compared to a loan. Biggest one, 100% financing, flexible structures. One thing we didn't talk about on the previous slide is we are a generalist. So we're a general lessor. That means in your shop, we can do everything from the fabrication equipment like we're talking about today, to measuring equipment, to forklifts, to overhead lifts, pretty much anything that you need that would be considered capital equipment for your shop, we can finance it here. So with that being said, we are a generalist. We're not focusing on a specific piece of equipment within your shop. And then the tax savings, section 179, again, we'll talk about that in detail in a bit. And then fixed payment and terms. And then this is one we touched on a little bit. Customers preserve their credit lines, cash, and working capital. Because our exposure is different than your bank exposure, it's not going to affect your availability at your bank. So you can leave it open for more of that, maybe receivable financing, your working capital, traditional real estate loans, things like that. More traditional banking products, because our exposure is going to be different, and we're not going to take a blanket lien. This is going to leave a lot of that availability with your bank open to some of those more traditional banking products. It is fast and convenient. We have a one-page application. I mentioned application only up to $500,000. And then with those turnaround times, that could be as quick as a day, 2 days in a lot of situations. 100% financing we talked about. Okay, so here's kind of an intro into the next slide. So if we do 100% financing, your payment is going to be higher because you're financing a larger amount, right? And then with the down payment, whether we require it or you as a customer would like to just offer a down payment, that is going to reduce the amount you're financing, so it's going to reduce your monthly payment. So here's a scenario with a dual table RoboSawjet, 36 months with no money down. Your payment could be as high as $11,000 a month. And if we did an 84-month term with 20% down, your payment could be as low as $4,400 a month. So what we're trying to show you here is there's a large variance, a large range in the payment based on the term and based on any potential money down. So what we always try to do as we're go ahead, Nick.
No, I'm sorry. I didn't mean to interrupt. I was just going to say
okay.
that, we get a lot of guys that ask us, well, what's the payment on the machine? And, it's so tough to understand what it could be based on so many different factors, right?
Yeah. Yeah, and you're spot on. I mean, there is a huge range there, or potentially a huge range there. And the other thing the other thing to factor in there is credit. I mean, if for tougher credits or more challenged credits, the payment is going to be a little bit higher just because the risk is higher from a financing perspective. Now, we have a lot of customers that have been in business for a very, very long time. They have very good business credit, very good personal credit. We can do an application-only approval for $400,000 in a matter of a day. We can do it for up to 84 months with no money down. And that's going to be the lowest possible scenario. Unless they wanted to put money down, that's going to buy down the payment a little bit. But with how inexpensive financing is right now, or has been and still is, I usually don't advise customers to put money down unless they really, really want to. So potential for no payments for 90 days. This is a big one, especially towards the end of the year, because as Baca might be taking their deposit, building your equipment, getting your equipment shipped, installed, getting you trained. It can take a couple, 2, 3, 4 months for that to happen. And so what we do is we try to get them paid, get deposits paid, and then move your first payment out for 3 months. So you're much closer to when you get the equipment, you start cutting with it, start moving product through your shop, and then getting it installed and getting customer bills out. So you start receiving cash around the same time that you start making payments. Another option is step-up payments. We haven't done as much of this, but we do have the opportunity to have the first 6 months as an example of payments where they're smaller in the beginning, just kind of ramp up, and then your normal payments would kick in after that. And then Section 179, we keep hitting on that as a teaser. We will talk about it, I promise.
It's a big one. It's definitely a big
one. Okay, here we go. So Section 179 is something, and I always preface this whether I'm doing a presentation or talking one-on-one with a customer. This is something we are not tax advisors, we are not CPAs, but I have been around this for a very long time, so I know the tax code very well. Section 179 essentially allows you to buy equipment and write it off in the year that you purchase that equipment. So, and there's always a lot of questions in regard to, what if I pay for the equipment and don't take delivery? What if I, at the end of the day, what we say is we want to have the finance documents written. We want to have the sales order or invoice with the vendor written and dated. We want to have it insured, and we basically want to have a portion of it, if not all of it, funded in the calendar year you're trying to take this benefit. So whether and there is some gray area from my experience in the years that I've talked to accountants, talked to customers, controllers, things like that. If you take delivery of something, if everything is dated in the calendar year you want to take it, you should be fine for, in this case, we're talking about 2020, right? So this is why November and December for us, for Baca Systems, for a lot of equipment manufacturers and finance companies, everyone is trying to get this in, get this purchase done, get it written by the end of the year. So the sooner you can do this, the better, because finance companies and manufacturers tend to get bogged down at the end of the year, not only because of holidays, but also because everyone is trying to do this at the end of the year. So the sooner you can start the process, start talking with Nick and his team at Baca, start talking with me and my team at American Financial Partners, get the application started so we can try to get an approval in place and get all documentation done here in the next we're looking at 6 weeks before the end of the year. So we don't have a lot of time left. And we'll give you some examples.
We see that a lot.
79 here in a bit. Yeah, sorry, go ahead, Nick.
We see that a lot. We see, this time of year, a lot of our customers are starting to call us. They're starting to do tax planning, and they'll start, understanding what the deliveries are. Obviously we're depending on the machine, can be 8, 10, 12 weeks out. And so, we want to have those conversations. The 90-day no payment that you guys offer is a great solution for that. Allows them to get the tax advantage, but not really start paying for the machine until they're starting to use it. So it's a wonderful solution. And this right now, this time of year is when we really start talking to all of our customers to start looking into that Section 179, because I believe that the next slide really starts to show what that means in dollar figures, right? Because it turns into a significant number.
It is, yeah, and those are great points, Nick. And one thing I forgot to mention too, a lot of times at this point in the year, and fortunate or unfortunate, a lot of people aren't exactly sure exactly how much taxable income they're going to have. So I encourage anyone who's listening and anyone who's watching, have a quick call with your controller, your accountant, your CPA, and get an idea for what your tax liability might look like, what your bottom line taxable income is going to be for 2020. Because a lot of fabricators I work with, and Nick and I have had this conversation too, a lot of the folks we talk to on a daily basis in this industry are having very good years and are doing very, very well. So what that leads to, that's a good thing, right? But what it leads to is more taxable income. So what we're trying to do is obviously get you into equipment that you can use and probably need anyway, but even more so get you a tax write-off that can, reduce your tax liability and, hopefully let you write a smaller check to Uncle Sam next year.
Yeah, absolutely. So I think, this is a great slide here that kind of, brings it home for, good portion of our customers out there. And so I'll let you explain what this means to a customer here, Josh.
Yeah. So what Nick and I worked on here is we just put together a kind of an average scenario for a fabrication shop in our industry, saying an example of $4 million in annual revenue. So the numbers tell us that 30% of that will get written off or wiped away with material costs. So you take out 1.2 million, another 30% for labor costs, another 1.2 million, and then 20% in miscellaneous expenses, so 800,000. What that leaves you with is a taxable income of somewhere around $800,000. Okay, so if you were going to write a check and you were in a 35% tax bracket, you would take 35% of $800,000, and that's your tax liability. That's what you have to write a check for. And so what we do in the bottom table is, as an example, say a dual table robo saw jet for $350,000 or whatever the equipment may be, you're writing off that $350,000 right off the $800,000. So that brings down your taxable income, and in a 35% tax bracket, you're going to save $122,500 in real money. That's dollar for dollar. So what that does in the bottom is it brings your $350,000 piece of equipment. You essentially only paid $227,000 for that piece of equipment. So a significant
savings. Otherwise,
there.
You would write that check over to the government, right?
Correct. Yep. Yeah. So you just by buying a piece of equipment, you saved $122,000.
Right. Towards a much needed equipment that can increase your capacity, that can help you save more on your material costs and reduce your labor. right? And all of a sudden it starts compounding on why you do these types of large investments, especially if you're, towards the end of the year having a profitable year and writing tax dollars back to the government, right?
Well, and that's a great point, Nick. And we've done this in the live seminars. I mean, you could spend a half an hour just talking about, by adding this equipment that's going to save you tax dollars, you're also going to reduce your material costs, so that you're going to reduce the labor costs. So not only are you helping dollar for dollar on the tax side, because you're acquiring this equipment, you're going to reduce your material costs and reduce your labor costs.
Yeah, you're setting yourself up for next year's success, right? To take on that extra volume if you have it, to take on the all of the things that we know in the 3 sessions that we did about the RoboSawjet, with the advantages that happens. All of that savings there, it just helps to be able to reduce your tax liability at the same time while you're purchasing a new piece of equipment. So we see larger companies every year, they're trying to max out their Section 179 because they understand that value, not only to what they're writing checks to the government for, but also what it does for their business the following year.
Right. Absolutely.
So I'll move us over to the next slide here. Because really what we wanted to do is we wanted to start working on what it looks like for a number of pieces of equipment for Baca Systems, and what sample payments could be, without using Section 179, and then because you use Section 179, what it really means to your bottom line, as you're making those payments, right? So, you look at you look at a single table RoboSawjet, where you're at your monthly payments, and then you turn around and you get that tax savings that we were just talking about with the Section 179. You could save about $1,000 a month, right?
Yeah, exactly. And in these 2 scenarios, and we'll go through several pieces of Aki equipment the same way, but on the single table Revolution and a machine price of $335,000 monthly payment, these are assuming 84 months with no money down, obviously based on a approved credit. And then we dialed it back to a 25% tax bracket, but we just wanted to give some different examples depending on your tax bracket. Things obviously are going to be fluid as far as tax rates and things like that going forward, but in this scenario, a payment of $4,690, because you bought that piece of equipment, $83,750 as a tax savings. So over 84 months, you saved, almost, like Nick said, almost $1,000 a month by purchasing the equipment and then writing it off using Section 179. So, and then the same thing on the dual table, just a little bit higher number, a little bit higher monthly payment, and then more in monthly tax savings.
Yeah, I mean that's a big number. That's $12,000 a year in payments, right?
Exactly.
If I'm doing that correct. You turn around and take advantage of the Section 179 this year, purchase the equipment. Next year, you save $1,000 a month. You're saving yourself writing $12,000 worth of checks next year towards payments towards machines, right? And
exactly.
that goes then over 84 months. I mean, it turns into real money real fast.
It's over 7 years if you're looking at the monthly payments.
Yeah, right.
So another example here, with the Mitre X, I mean, a monthly payment of $599, tax savings $10,500. So just by using the Section 179, if you over an 84-month term, $125 in monthly savings.
Yeah, and we did a virtual fabrication seminar on the Mitre X as well, and honestly, you think about what it takes for your guys to be mitering, for the amount of capacity that you have on your saw to be mitering to produce better edge details. The ease of use with the mitering machine. The miter's not moving, and you think about what that payment is on a monthly basis. Um, Man, it just makes sense to have that piece of equipment in your shop, especially if you're going to turn around and write tax dollars towards the government for it. So, to take $10,000 off of the machine that's very, very valuable in your shop, it's huge.
Yeah. Yeah. I mean, $600 a month for that equipment is not very much.
No, no.
Another
So
example is the boss saw. Um, Using a machine price of 155, monthly payment of 2180. Tax savings in that scenario is 38,750 in 2020 savings. And if you equate that to a monthly savings, it's over $450 a month. The Edge router, $245,000 equipment cost, monthly payment approximately 3,450. Tax savings on that one, 61,250, monthly 729. I mean, this is again, it's a powerful piece of equipment for $3,400 a month, and really, $2,700 a month once you factor in the monthly savings.
yeah, so you look at that's a good point. You look at $2,700 a month for an Edge XL router that is polishing sinks, that is doing exotic edge details. It's polishing radiuses. It's a great piece of additional machinery in your shop. You want to go and you need another polisher in the back of your shop. The labor's tough to find. I can't get the guy. And then when you do get the guy, he's experienced. He doesn't come cheap. Not between what you're going to pay him for his labor, and then you've got the insurance on him. You've got the workman's comp that goes behind him. All of that. You're going to spend more than that for one labor in the back of the shop than you would a router. And the router can do so much more for you in the back of the shop in terms of consistency. We talk about hot sauce all the time of adding chip minimizers to your sink details. That is nothing for the router to do. And so that's why you take a look at really what that monthly payment can be. And then you get the tax savings behind it, and you say, well, $2,700 a month for what this machine is going to produce for me every single day. It really becomes a no-brainer.
And that the Edge doesn't ever call in sick either, right, Nick?
That's right. Shows up every day.
All right, Edge Sync Pro Plus, another example, 145 monthly payment, $2,000. The tax savings 36,000, monthly savings 431. Bottom line,
Yeah.
we're showing you all these numbers, different examples on great equipment that everyone can use and increase their output, increase their efficiencies, reduce their labor costs, reduce their material costs. This, whatever it is you need, you can buy it this year and get a huge tax savings by simply buying something that you most likely need anyway. And yeah, we've seen so many customers over the years take advantage of this. My only wish is that customers would do it earlier in the year, but it's just human nature. And this is November and December is when we write a lot of these, and that's okay. We'll do whatever we can to help customers out.
Yeah, absolutely. I would, and I gotta, reiterate the sentiment that you should be calling your accountant right now and figuring out, what your tax liability looks like for this year. Doing some 2021 planning, and figuring out what that business looks like and whether or not you're going to need to be adding more labor into the facility, and start looking at what it means to just maybe adding a monthly payment, taking advantage of the tax deduction, and setting yourself up for success. So, okay, we've talked about the numbers. and they say they want to add. So what's the process for you, Josh?
Yep. So we have an application only, a one-page application process. At the very least, that's where we start. So step one, complete the application. We have a PDF version. Otherwise, the easiest way to do it, and a lot of guys are doing it from their shop, from the field, right from their phone or their tablet or laptop, afpstonefinance.com. Otherwise, it can be emailed or faxed to me or to my office. And then basically that's the starting point. Once approved, then we discuss options, send out an approval letter with the terms and any potential down payment that's needed. Basically, what we try to give several options, typically anywhere from 36 to 84 months on this type of equipment and this price point. So we send that approval letter out. Now, if financial statements are required, either it's a newer business or there are some credit dings or lack of credit, things like that. The most we really would ever ask for is 2 years of tax returns and 3 months of bank statements. So those are some things that we do from time to time need to ask for if there's a lack of information or if there's any derogatory or negative information that we find. Step three, once we get the approval letter back, what we do is we go through all the documentation. We get final invoices from Baca Systems or whomever the vendor is or manufacturer is. We work with the insurance company to get a certificate of insurance, coordinate delivery, payment to the vendors, obviously, whether that's wire, ACH, overnight check. So once the vendor is funded, production delivery is scheduled, and away we go. So pretty simple and quick process. Are there any questions? I think you're muted, Nick.
Sorry about that.
That's all right.
Okay, so let's say they get approved. Who pays the deposit? How does that work? How does that whole deposit to the vendor work?
It is an amazing question. It can work a couple different ways. Most of the customers will just let us make the deposit, whether that's 20% or 50% or 90%. It kind of depends on what the equipment lead time is, and what we're looking at from a time frame there. So I usually say let us make the deposit, and then again, going back to that deferred first payment, if there is going to be a lead time, your first payment isn't going to be due for 90 days anyway if we get you approved for the 90-day deferred. So we're making the deposits. Customer is not parting with any cash, writing any checks. And then basically their payments start 90 days from the time we fund the first deposit. Another way it can happen is the customer can make the deposit directly, and we can reimburse them once Baca is ready to be fully funded, or majority funded up to 90%. So one of two ways that can really work, and it's really up to the customer if they want to write a check for 20% and have us wait to start the lease or finance agreement, or we can make it directly to Baca.
Excellent. So at this point, anybody can text in some questions and submit them to us. We do have a question that's asking if our lead time is 4 months. We try and keep our lead times as low as possible. It really depends on demand, what we're producing. Obviously, COVID right now is putting everybody's business kind of on shaky ground with how we're really able to work. We're in Michigan, and the work restrictions in Michigan has been something that Baca's had to do. We've done a really good job of keeping our lead times down still. But you can find simple machines like the Mitre X that have maybe a 6 or 8 week delivery time. And our goal is to be able to get them so that the way they're ready to ship. It really depends on the machinery, the time that you purchase, what's happening, and so our lead times are dependent. I would recommend that as you get close to purchasing, you contact your account executive, and he'll really verify what the next expected delivery date is for that piece of machinery. Okay, so another question, this one's for you, Josh, is uh, can you split the deduction over multiple years if you're at a maximum deduction for 2020?
Yeah, that question comes up quite often. So again, you want to work with your accountant, your CPA, controller, whoever is writing your taxes every year. What I've seen happen a lot is, okay, I'll give you an example. Say a customer right now in 2020 is going to have $200,000 in bottom line taxable income, but they want to buy a $350,000 piece of equipment from Baca. Now, what a lot of accounts that I've talked to and I've seen them do is they'll take the entire deduction, and then you can do what's called a net carryover. So you're carrying over a portion of that loss, if you will, because essentially then you're showing $150,000 loss, right? So 200 minus 350 is minus 150. So that could carry over to 2021, and you're basically showing that net carryover loss for next year. So it it does kind of work that way, but again, that's a CPA question. It's not something I can give you that suggestion or that advice on. But that's the way
Right.
it should work.
Right. Um, okay, so with all that being said, can you still finance this year and get the Section 179?
Absolutely. Yeah, and that's where I'm saying that we've done finance agreements and leases. I would say the day after, maybe 2 days after Christmas, and still gotten everything done. But if you go much later than that, it's not going to happen. So again, the sooner the better. It's not a good idea to wait until even a week before Christmas. I would say you're pushing it.
I'm sorry, Josh. I feel like you're setting yourself up for a lot of guys calling you right
Nick,
before
we
Christmas.
have it every year. The day after Christmas, the phone is ringing off the hook.
Yes, I've been doing this a long time,
Yeah.
and I tend to get a lot of frantic phone calls that week.
Yeah.
Um,
So at the end of the day, the sooner the better. But yes, absolutely, there
yes,
still is time to get financing in place, to get everything documented this year.
yes, it's tough to say that tax planning is a year-round event, but you know, it seems
It's
that
not
towards the end
anyone's
of the year
favorite
becomes
thing to
a little.
do.
No, no, but certainly you don't want to write that check and send it off to the government when you could put it into your own business, right?
Exactly.
So with that, I think I'm good on questions. I'm not seeing any other ones come in. Is there anything else that you want to go over?
I don't think so. I believe my contact info is in here somewhere. If there are any specific questions, my cell phone's always on. I always will answer emails. If anyone wants to give me a call or email me with questions specifically to Section 179, it is not the most glamorous topic, but as Nick mentioned, it is very, very important. And if you can save money, um, by not having to write as big of a check to the government, I encourage it thoroughly.
Yep. Um, okay. Well, listen, I appreciate it. Thank you, everybody who's joined us on the call and asked the questions. Thank you again, Josh. As
Thank you.
always, you can fly to Detroit. You can contact us by email or call us, or we're happy to send our account executives to your facility. But certainly, we'd love to see you into Detroit to look at all of our machinery. And we look forward to hearing from you guys in the future. And if you have financing questions during that process, we'd be happy to put you in touch with Josh and his team at American Financial Partners.
Thanks, Nick.
So thank you very much.